Hello and welcome to this Moneycontrol live stream. I'm Nandita Khemka and we have with us today N. Mahalakshmi, who's our consulting editor, and we'll be talking about the messaging that has come out of the minutes of the FOMC's last meeting, that is the November meeting, and its impact on the markets. Now, the minutes have indicated that Fed members are in favor of reducing the quantum of rate hikes going forward. Now, given the fact that Powell had already indicated that during the FOMC meeting last month that there is room to reduce the quantum of rate hikes. ML, this hasn't really come as a big surprise to the markets, but this is something that the markets needed to hear because a lot of Fed members have been making some hawkish commentary over the last fortnight or so. So, given the fact that now there is clarity that the Fed is okay to reduce the quantum of rate hikes, do you think this will help the kind of up move that we have been witnessing in the markets over the last few weeks?
I think it's a supportive. It is more a supportive news than something that can trigger a rally. We saw that yesterday. Markets in the US were buoyant, about 0.5% up on S&P 500, about 1% up on Nasdaq. But then there is nothing too much to read beyond what we have already heard and read after the last commentary. The big hikes are probably over, and we will probably see one or two hikes of 50 basis points before the Fed actually, going forward, the Fed will have to still recalibrate its move depending on what data comes out. Right now, the only thing that is clear is inflation is on a trajectory downwards. We don't know how quickly what is going to be the pace of inflation going down. It could go down at a slower rate than what the Fed expects. We also don't know how the economy, other variables, the economy variables, the job, unemployment rate, etc., are going to pan out. Those are all going to be determinants of what it is going to be after January. But for now, I'm sure there is going to be some period of breather that Fed will take, because they want to see the full impact of what is already done to be able to calibrate their moves going forward.
Right, ML, the quantum of rate hikes will be reduced, but the rates will continue to remain high. 5 to 7% is what Bullard had indicated in the over the last couple of weeks. So rates are not going down anytime soon. We've seen that foreign investors have made a comeback in the Indian markets in the month of November, 30,000 or so odd figure coming into the Indian markets. But now, do you expect this bit of news that the quantum of hikes will go down? Will this provide some kind of a cushion and the inflows will continue from here, or are there any factors?
Before taking that question on inflows, we have to go back and say, what is it that the members are doing this for? It's very clear that one of the things that is playing in their minds, the Fed members, is that there could be, now there is a threat of financial instability, and we've seen that play out in the private markets. For example, look at what SoftBank has happened. So when you know that you're accustomed to very low levels of interest rates, and suddenly you have a huge spike, and there are companies and funds that are really levered, so a lot of wealth can get destroyed. So, and of course you have impacts on the economy and stuff like that, which will have deeper impact, and if you get into a deep recession, what happens later and all that. So therefore that is important. Why am I saying this? So therefore we still cannot conclude that the two important points that we will have to still watch out for is what is the level at which we will peak, and how long are we going to stay at those levels. There are people who say that we have, in the last 20 years, we've got accustomed to lower rates, so we don't think more than 1 or 2 quarters we will stay at those elevated levels. But I would sort of not conclude that way, because we are seeing this happen for the first time in 40 years. So we can't really say that the trend of the last 20 years will continue, or we are seeing an inflection point from where a start of a new regime in interest rates can happen. Now, coming to the second question, the question that you really asked about inflows, and I think all of these are really connected. The inflows are back because the risk perception is low now, and as long as there is no disturbance at the global level, as long as we see the rate trajectory not go completely out of whack, as long as we don't see anything that is specific to India in terms of macro variables that will affect us more than the others, I don't think it will reverse. At the same time, this does not provide us, an endless cushion. All of this can change 1 or 2 months later, depending on how the macros in the global situation evolves.
Right, you spoke about a slowdown in the US, so there are chances of 50% chances of a recession in the US next year that even the Fed members have agreed to. We've seen layoffs happening at US tech giants, Google, Alphabet, and most recently Facebook, Meta. So, in light of rates remaining high, do you expect bonds to emerge as the preferred bet for long-term investor because equities will remain volatile going forward?
Yeah, so in the US for sure it might be an interesting option because you haven't seen these high rates in a long time. So suddenly you're coming from 0-1%, which was not an option, to 3-4-5%. It suddenly starts to look better.
Yeah.
But in India, but there also real interest rates are still negative, so there is no case really for bonds. In India, I think the worst case situation in terms of earnings growth for this year, next year will be like 10%. Okay, and today if you look at SBI, it might offer you about 6% on a 3-year bank deposit, and then you have to impute tax on that. A Bajaj Finance, which is a good credit, will offer you 7.5% for 3 years or something like that, 7.3% or something. And so net of taxes, those are still not credible numbers compared to the earnings growth that India can deliver.
Right.
The only catch out here is obviously earnings can grow at 10-15%, but if the valuations are elevated and you see some capital erosion, then how does the equation really change? I would say today valuations are not at levels where you will see serious capital erosion, so you don't have to be really worried about that. I mean, they are more muted than we have seen many times in the past. And therefore, if you take a slightly longer term view, I think the case for equities is still fairly strong compared to bonds. At least that's what I think.
Right. When you spoke about valuations, I want to talk about the Indian market valuations as well, because we've seen the Nifty seeing resistance around that 18,300 to 18,200 levels, but once again it has kind of resumed its up move, inching towards that 18,400 mark. How soon do you expect Nifty to edge past its previous record, that's 18,600 or thereabouts? In fact, the couple of experts I had spoken to were saying that it could happen as early as December, because that's the time when we generally see a Santa rally on Wall Street as well. And now that we've got this messaging from Fed, I mean, won't be surprising to see a Santa rally play out on Wall Street. And picking cues from there, do you expect us to also clock in a healthy up move in December?
All of this is very dynamic, Nandita. It's very hard to say. First of all, it's very hard to predict. So we shouldn't even try to do that. But more importantly, if you were to surpass an all-time high, there has to be some really strong trigger for you to take the markets to higher levels. Is it a global trigger? Is it some very big good news that is coming to take us higher? I don't see that happening. At best the markets will sort of you have some huge surprise on inflation data. For example, if it's 7.5%, you have like a serious cut in that data. Then maybe the markets will be super excited because they say that okay, this is a phase that is going to get over very soon and it could rally. So on the domestic front, again, I don't see any trigger. Of course, budget is a trigger, but I don't see why we will anticipate a great budget, right?
This is the last one for before the 2024 elections as well, right?
Correct. So you're not going to expect a great outcome from this budget. There is no serious reform or anything that people are looking forward to. There's no big investment target or any of that is being spoken about. So it's going to be the expectations around the build up to the budget is also not looking very exciting. So I don't see any triggers that could propel markets to a all-time high, or at least surpass the previous high. The second thing to remember is the 18,300, 400 that we are seeing today is very different from the 18,400 we saw last year. And I'll tell you why. One of the very important indicators is retail participation. And this is the first quarter, the September quarter was the first quarter where the retail participation in the markets actually came down in terms of, in terms of shareholding. Right. Second, the share of retail trading volumes has now come down below 75%. During the COVID period, it went up to 85%.
Quite a bit,
so now
yes.
the COVID investor is pretty much out because last 1 year you've sort of had a lot of pain in markets. A lot of retail investors have really not made money. One segment of investors is this IPO investors.
Right.
Now you see that most of them are either below their issue price or or at least right out
somewhere
there.
around.
So you have really not made money in secondary markets. You have not made money in IPO markets. So that retail interest is waning. Third thing is, if you look at the discretionary investments in mutual funds, the SIP part is really consistent and strong.
Right.
But the one-time lump sum money that was coming into it has become next to negligible. So, which means the support that we have in terms of domestic flows, which is what really supported the selling from FIIs all of this year.
Yes.
That support is weaker today. I'm not saying it's not gone away because the SIP flows are still strong.
Yes.
But retail participation in direct equities, the lump sum discretionary money that has come into that has been coming into equities, all of that has gone away, nearly gone away. So so we don't so definitely on the flows front we are not looking any better than earlier. Of course, if the FII flows continue or even selling has stopped for now, if that remains the case, markets will be steady. But there is no reason to believe that it can
there'll be a knee jerk,
that.
exactly, and
it can go higher.
Another thing that is going to happen, of course, is the last RBI meeting of this year, which will happen in December. Expectations are that the RBI will be raising rates by somewhere around 35 basis points to 50 basis points. But then there's also chatter that this may be the last rate hike by the RBI, as inflation in the past month had cooled off below that 7% mark. So what are you picking up from the people that you spoke to?
So for RBI, I think our strategy is not so much to do with our own inflation. Of course, inflation is a problem here also, but I think RBI's strategy will be definitely more focused on what is the interest rate differential that we maintain between US and India. Right now, the yield gap between US and India is still in a very narrow, it's very narrow compared to your historical standards. So therefore, anything that happens here and whatever is the rate calibration that RBI will do will depend on how the global scenario emerges.
Right, two comforting factors. One is dollar has eased off from September highs, and secondly oil has come down quite a bit. So these are two comforting factors which the RBI may also take into consideration. But another thing I wanted to ask you was, do you think that the dollar rally is out of the way, or has it peaked out? Because a couple of experts I spoke to were saying that this is just a correction phase, that risk appetite may have returned for now, but once the dollar starts picking up again, then it may get dented once again.
So all of these things are really connected, right? I mean, we are talking about risk appetite coming back. Why? It is because there is more clarity in terms of rate hikes not being as high as before, it being stabilizing, data becoming more amenable for policymakers to not take a very tough stance. So that is what has brought back risk appetite. And if we continue like this, I don't think it's going to be a reversal.
But there is no evidence as such that that inflation has started to cool off, because it's just 1 month of inflation coming down, and the rate hikes are yet to actually percolate into the broader economy, right?
Correct.
So last question to you would be, when I spoke to some experts, they were betting on the banking space in a big way because earnings have been so good. And do you think this is the sector that will emerge as one of those sectors to bet on going forward?
So that has already happened all of this year. If you see, banking has really emerged on top. I mean, it's been the best performer. Of course, PSUs have been also a wonderful bet, but banking has been a great performer. But I have some now. Of course, the huge value gap that you saw in banking is already sort of a good part of it has been bridged. Now going forward, that it doesn't offer you the deep value opportunity that it offered you about a year back or 2 years back. To that extent, they will also have to now start delivering on growth. You'll have to see that they are able to this credit growth continues and there is no slippage, because one area where we have not seen too many delinquencies is the SME and retail segment, and there is still a lot of stress there. So far there is no sign that could become a huge problem, but that is still, the NPAs have not emerged, the write-offs have not therefore happened, so that's like a dark spot. So there could be negative surprises there. So we have to just tuck that in mind. Right now it's not a big risk, but we can't ignore it either. Second thing is that banking still continues to look good because rest of the sectors are not necessarily looking as good. Either they have elevated valuations, or they may be susceptible to some kind of growth
plus cost pressures for certain sectors as well.
Cost pressures, also demand pressures. If you look at staples, discretionaries and stuff like that, there is also rural demand is now becoming a pain point. Aggregate demand, because of festival season, we've done well, but we don't know whether that is going to continue going into the next 2 quarters or beyond. So because other sectors have these pain points, banking today is looking good on a relative basis, but for them to deliver, you need to really take a strong bet that there will be a revival in private capex that will happen sooner than later, and therefore credit growth will sustain, and profits can grow, ROEs can get better, and all of that.
Right. So overall setup, according to you, is looking pretty okay when it comes to the year end. Into the next year, we'll have to see how the data pans out and what global central banks do in light of the data that's coming out. Well, that's about it from us in this Money Control Live. For more such news and updates, keep watching Money Control.